Hello, my name is Michelle, and I will be speaking on the future of digital assets and the role that exchanges play in financial markets. Now, there's a lot of complexity and changes coming in the near future, and I'd like you all to think about what implications this technology will have, not only for you as a crypto investor, but also as a traditional investor, as we are seeing this technology create more and more institutions and TradFi protocols. I'm very keen to see what 2023 will have in store for us as we explore the financial revolution driven by blockchain. I'm not sure of the levels of blockchain and crypto knowledge in the room, so I've tried to provide everyone with context on past technology advancements and how they are driving innovation today. So I want to start off today with a story because honestly, it was fascinating to hear it firsthand. I was at the Chainlink SmartCon conference in New York City this September, and I started speaking with a guy next to me at one of the talks. He worked for a small bank system in Massachusetts, and he used Salesforce to build essentially all the bank clearing systems. While he recognized that Salesforce was an amazing tool for increasing productivity, as he started looking into blockchain tech and smart contracts, he came to the realization that this technology could take away 90% of the bank processes that he was in charge of automating. This was just insane for me to think about, right? He was so inspired that he left his job to pursue more education and was invited to the Chainlink conference to get more insights on what the future holds for this amazing technology. There's also one quote I like to think about. 20 years from now, we'll look back and say, remember when there were banks? So if you're thinking about a career move, blockchain is a great place to start learning and developing skills. So digital assets, how did they get their start and why are we still talking about them? Well, decades ago in 1998, there was a guy named Nicholas Scavo who pioneered something called BitGold, but it didn't really get much traction then. And then 14 years ago, well, 15 years ago now, a person or a group of people, no one really knows for sure, under the pseudonym Satoshi Nakamoto, released a white paper outlining the model for blockchain and in the subsequent year, released the first blockchain as a public ledger for transactions made using Bitcoin. This innovation cuts out intermediaries from transferring value all over the world using computer code and global actors incentivized to promote good. So why was this so innovative? Well, until that moment, all we had known is centralized and regulated entities creating and controlling the transfer of value all over the world. The traditional banking system lacks transparency and interoperability, has high transaction fees, which often go on the burden of the customer, and allows for financial power to be more distributed among the few instead of the many. So, with the development of Bitcoin, Ethereum, and other change, there's now an opportunity for a new financial ledger, which will reduce costs, create a new public and reputable way to manage data, leading to the tokenization of anything and everything, with new encryption and data transfer methods that secure our financial assets for the future. Now let's fast forward to 15 years later. Of course, this technology is still very young, still a teenager really, but we've made some significant innovations in finance since then. Tokenization, especially in the last 2 years, has been a heavy focus for most financial firms. After the creation of NFTs, it seems that we can put almost anything into digital tokens and use it as data storage to create interoperability among systems. Literally, Charmin toilet paper put toilet paper into an NFT this summer and use it to raise money for charity. By 2030, it's expected that 16.1 trillion US dollars of financial assets are expected to be tokenized, with 10% of the global GDP being stored and or transacted on distributed ledger technology, or DLT, going forward. That's a 24,000% increase in 7 years. And as you can see, it's happening to all different sorts of financial products: bonds, home equity, stocks, ETFs, etc. So in the near future, you might even buy your government bonds that are held in blockchain technology. There's a whole new order with the promise of tokenization, and therefore TradFi banks and centralized capital market firms are all finding ways to use blockchain to deliver more efficient services to their clients, whether it be in indexing, post-trade, order management, and data management, all of which we will talk about more in depth later. So a lot of what you hear currently about the crypto movement, and especially in the wake of the FTX fiasco, is that the future is DeFi, right? Or decentralized exchanges, mainly because they allow for your own custody of your private keys, and therefore they're your assets. It's also considered more of supporting a world order of currency, not segmented by countries, which causes some regulatory complexities on a mass scale. This is a noble goal, I will admit. However, in the traditional finance and crypto world, centralized exchanges are still quite important to the financial system by creating a higher level of responsible development and security, as well as education to the broader community. And of course, they are the main drivers for liquidity in the markets. So here's a great quote. While DeFi presents new regulatory challenges, there are many ways to ease this burden initially. Centralized finance companies can be the interim solution, serving as a bridge between the traditional financial sector and the regulatory framework that encapsulates them on one hand and the decentralized finance space on the other. These companies very well understand the sector from both the infrastructure point of view and the needs of their users. So basically, there's a lot of innovation, new financial assets, payment options, etc., coming from this global technology, and we still need centralized entities to help mold the conversation as we bring the new world into this digital era. You'll see in the coming slides several examples of what some of these businesses are doing to drive blockchain technology into day-to-day financial systems and the risks and problems that come along with it. So for this next part, I'm going to break down future developments of the blockchain and crypto financial world into 3 parts: infrastructure, adaption and adoption, and CeFi, DeFi hybrid solutions. In these 3 ways, you can see how global exchanges and firms like Deepcoin, DCC, Chainlink, and Digital Asset Research are driving the future of the industry and what progress they have made so far. So since 2020, most asset management firms and banks have been investing or moving towards blockchain technology in some way or another. Even Jamie Dimon of JP Morgan, notorious hater of crypto, can't deny that his bank has been publishing new tokens and working on integrating this technology into the banking world. Current infrastructure has a lot of manual processes, requires paper-based transfer of ownership, which is costly, error-prone, slow, right? I'm sure that John in the mortgage processing department is sick of his day-to-day workload looking through the same documents. So if we can automate this with smart contracts, we're going to make John's life and many others much easier. The current system also breeds market fragmentation and a lack of industry standardization, meaning it's hard for different centralized systems to communicate with one another. This also causes possibly unnecessary compliance and suitability rules, more bespoke and reactive than could otherwise be in a new system. So in 2020, DTCC, the world's largest security settlement organization, spearheaded a prototype for using DTL in settling stocks that is still in testing, but has already led to significant innovations in market settling. So while the prototype mints tokens and records asset transfers on the public Ethereum network, it maintains an independent digital record of security ownership and performs real-time compliance and suitability checks off-chain. Additionally, the core infrastructure is architected to enable integration into additional distributed ledgers, like the Hyperledger fabric, and that's based on market demand. So this compliance oracle here offers a dynamic rules engine that enables issuers and investors to maintain compliance throughout a securities lifecycle by approving or rejecting transactions. And when a transaction is approved, the stock record is then updated and the movement of the token on-chain occurs. And this can be done through an on-chain transfer, all called via API. The new system would allow for any company to raise capital through an equity offering in a transparent and compliant manner on the blockchain, while reducing fees for investors and providing more investor outreach throughout a global ecosystem, instead of just the ones in a certain network. You can read more about this project online and all its ins and outs. Project Whitney. Great, so these new protocols, they of course deliver a lot of enthusiasm, but there are of course still challenges to overcome in order to bring about this new technology mainstream. With tokenized assets, institutions now need to assess how to use and develop smart contracts and how they execute past procedures, which at this point, although they can execute and be validated independently, this is still quite slow depending on the length of the code or data stored within each block. There is also a lot of regulatory uncertainty in the industry, given that the tech is so new and that seemingly the average person doesn't know how to navigate and trust the crypto industry. Private keys, while good in theory, can be lost or forgotten. Big exchanges or crypto chains can manipulate markets, as shown by Mt. Gox, Luna, FTX, Celsius, I'm sure others to come. It's increasingly important for institutions to consider the financial literacy and education needed to properly equip individuals to manage their funds. Also, moving people away from physical documentation into the digital era could be tricky. What happens when we no longer have physical paperwork? Could the tech be manipulated somehow? This will be explored more when we get into the topic of CBDCs. So briefly, I really want to touch on how this new infrastructure is driving development in the indexing and information sharing world of capital markets. So last month at SmartCon, Chainlink, Digital Asset Research, and FTSE Russell did a fascinating panel on the use of Oracle smart contracts to enable data nodes on-chain to facilitate more efficient and speedy processing for indices. FTP and CSV files are still the main transportation model for data right now, and imaginably that's slow in a global industry where multiple trades happen within every second of every day in crypto, right? So this is another cool use case for the blockchain that we are now seeing develop. So right now, most of the crypto world is working off stablecoins and pegging to the US dollar, which has been great for the industry and keeping in touch with the current financial order. Stablecoins minimize volatility as well when they are managed properly. Of course, the best stablecoins are those backed by reserves, such as USDT or USDC, but with algorithmic ones, we have seen that those haven't always boded well. The Luna fiasco allowed for one bad actor to wipe out millions in liquidity in just hours. It's a major point of regulatory concern as well, as governments will try to understand how to properly regulate and tax on these funds and the transfer of them. So the utility of stablecoins has led major nations to research and develop their own, central bank digital currencies, CBDCs, which is a digital form of their country's sovereign currency, and it's a liability of the central bank. It can serve as legal tender, and it can be converted one-to-one for paper currency or for reserve balances, and it would clear and settle within finality and nearly instantly. These are currently already active in the Bahamas, Nigeria, and the Caribbean Currency Union. And, this technology is already allowing users to send CBDCs without banks, reducing the number of unbanked in those regions and providing financial inclusion. So there are a number of G7 countries currently in pilot testing a CBDC, and this month even the US Fed announced a 12-week pilot with major banks to assess the technical feasibility, the legal viability, and the business opportunities of using DLT. However, what is the real implication of a new world order with CBDCs run by governments? Sure, it will help us reduce fees from payment systems like credit cards, but won't it give more control to central banks and governments? If they can send money to those in need, can't they also take it away? To what extent will governments monitor and start to take away financial privacy from the individual, right? Most people in the crypto industry actually find CBDCs to be the antithesis of the DeFi movement. You can watch all sorts of videos online from crypto enthusiasts on the potential threat to democracy should these become more prevalent in society. I tend to agree that this is something we must be careful about implementing in society, as the disadvantages to individual sovereignty will likely outweigh the benefits. Now, another digital asset class that we've all come to love and hate are NFTs. While sometimes NFTs can feel like the new age of trading baseball cards, there are many practical implications to this technology. Giving data decentralized veracity and provenance is a huge value add for the internet as a whole, furthering Web3's value proposition, a community-owned web where participants help govern or partake in the development of brands, goods, and services. By purchasing NFTs issued by, say, Nike, you may now get even more valuable insights into special product lines and be able to drive development of the company from your needs, and possibly own your own data in the process. So exchanges and firms like DecaShares are increasingly developing infrastructure to make NFTs more useful for the average customer, most importantly in physical real estate. A downside of having your property's title deed issued on paper, right, is that it can be easily lost, altered, or forged. The tokenization of physical property can make buying and selling real estate more efficient and secure. Since NFTs are stored in a blockchain ledger, Anyone can track their ownership history and previous transactions to verify their authenticity. Moreover, thanks to the immutable nature of blockchain ledgers, minting your title deed or any other document as an entity could drastically minimize the risk of malicious actors falsifying your property documents. Minimizing the bank and governmental processes needed to close in your house is a good thing, right? All right, now shifting gears here, I want to talk about the necessity still of centralized exchanges and firms on the adaption and adoption of these digital assets to the mass public. So 99% of transactions are still happening within centralized exchanges, and for good reason. While, of course, DeFi cause is noble, as mentioned, there's still a lot of infrastructure and knowledge that lacks in the broader public to find usability with DeFi exchanges. And while, we're seeing more and more development of these DeFi exchanges, and they're going to provide more financial stability and freedoms, there are still several matters that centralized exchanges are able to handle better, right? Centralized exchanges have the burden of being larger and more public, and therefore have the liability of being responsible actors in the growing ecosystem. That means they can help to drive regulations while also being scrutinized to them. DEXs also offer fiat to digital asset support and onboarding support in general, offering education and liquidity for these new digital assets. And of course, as DEXs are still struggling with liquidity, transaction delays are still quite prevalent. But of course, there are several chains working hard to address these topics. DYDX, Uniswap, all the big ones. While centralized exchanges are much safer as they are more regulated, there still needs to be democratization and more fair business practices, which leads to maybe a CeFi DeFi hybrid, CDeFi future. A few years ago, this concept arose, and it's on the rise again after the fall of Celsius, FTX, BlockFi, you name it. What if there are ways to leverage DeFi protocols like AMM, yield farming tools, etc., but in a more centralized manner, right? Maybe we can take in some of the regulatory compliance rules, the KYC and AML, and somehow integrate it safely with more of the DeFi protocols. We can create perhaps a hybrid model using smart contracts and intermediaries together to create more flexible and democratized system for the greater good. Binance also started this process with the creation of Binance Smart Chain, and it's continuing development as we speak. Deepcoin is also looking into this as well, and we'll see some future advancements into a more integrated system down the line. So we hope that DeFi can piggyback off existing infrastructure of centralized exchanges to increase security and liquidity. This also breeds more interoperability with other chains like Ethereum's EVM. But of course, this system presents some challenges in its adoption, as there may be more privacy potentially, but more volatility. Also, there is still a lack of strong regulation, which can lead to scams. And this concept is still very complex and may be difficult to onboard everyday users. So about us. So Deepcoin, again, as I mentioned, we are developing a lot of these DeFi, CeFi principles right now, which I'll talk about later. And okay. So about us. Deepcoin launched in 2019, primarily as a derivatives exchange, as a way for users to use innovative tools to trade digital assets. Right? We are one of the most popular exchanges in Asia, with over 2 billion in trading volume daily and more than 2 million users. Our mission is to provide you with fast, secure, and innovative tools to boost your decision. We have had over 4 years of successful operations in Singapore, Japan, China, South Asia, and now we're expanding more to the West. We are standing strong despite the recent downturn in growing business operations to support more clients globally. We are releasing a proof of reserves report using the Merkle tree method to emphasize our part in becoming compliant across the industry. At Deepcoin, we are constantly looking to provide futuristic tools to equip our users with ways to engage in the crypto markets. So we offer K-line quick trading, which allows you to use sophisticated tools to set a price point, place a trade, and change orders all directly on the chart. So there's no more switching back and forth between pages. And, it's a very clean interface. We also offer a dual price liquidation, effective leverage, and indicator schemes to help you understand your trades and avoid liquidation. Lastly, we have implemented industry standards, but safe DeFi curve yields of up to 8% on your funds in Deepcoin. But of course, if you want to keep your assets more safe, we support all withdrawals and even subsidize the on-chain transaction fees from TRC20 transactions in good faith to our users. Deepcoin continues its commitment to the development of digital assets by supporting over 150 tokens and coins in the ecosystem, and that number is growing daily. We properly vet each token to ensure its validity in the market and provide educational resources to our users about the project and tokenomics. We are also finalizing development on USDC perpetual contracts, giving our users even more ways to engage with the markets on a new stablecoin. Finally, we are assessing new ways to engage with the CDFI principle by building new wallet integrations to ensure secure and transferable assets. Thank you so much for your time. I hope you enjoyed this presentation. Please come by our booth if you are at the event, and best of luck in your digital asset journey. Thank you.